Hi Fools, I'm David Williamson and welcome to Market Checkup, the Motley Fool's healthcare focused investing show. We're going to go over some of the week's winners and losers. We have a nice big pharma headline for you, a fun game over who could buy an up and coming biotech, and also a stock with a lot of controversy around it that I will be watching closely. Let's start with our winners, and our first winner is Anika. Yes, shares are down a little today, but trust me, it is a winner. They increased in value by over a third after receiving FDA approval for Monovisc, which is an osteoarthritis treatment that is injected directly into the knee, which I'm sure is not comfortable, but the drug works and it received FDA approval. It will be marketed by Johnson & Johnson, so Anika has a heavyweight behind it, and it will compete with some other single injection treatments as well, so it will not have the entire market to itself. Now, Anika receives an upfront payment of $5 million, but it does receive a nice royalty stream as well. On the surface, it does appear that investor excitement has potentially overshot the company's valuation, but Anika's growth makes it one for investors to watch. Now, our second winner is Mylan Pharmaceuticals. Now, it looks like Mylan is keeping active with activists, which I guess is the generic drug maker version of keeping up with the Joneses. Activists, of course, has been aggressively acquiring companies, recently purchasing Carl Icahn favorite Forest Labs. Now, Mylan has not ruled out M&A on its own. They had a quote from their press release that said, "We currently expect to be in a position to execute on a substantial transaction this year." This has investors incredibly excited, and it wasn't just Mylan's aggressive posture to growth, which has worked out well for activists, but its quarterly results were very strong. It beat estimates, and more importantly, it impressed with its 2014 guidance as well that included $8 billion in revenues and $3.43 in earnings per share at the company's midpoint, both well ahead of what the street was expecting. Part of that growth will come from a generic version of multiple sclerosis drug Copaxone that Mylan has on the way, which will hopefully for the company get approved and be a big seller. But strong day for Mylan and a strong week for Anika. So let's move on to our losers, and we really only have one loser today, which is Catamaran. Shares of the pharmacy benefit manager are down over 10% after reporting disappointing earnings. Actually, the earnings themselves weren't too bad. Catamaran beat by 2 cents, reporting 56 cents per share, and just actually crushed it on the top line, notching $4.5 billion in revenue, $500 million more than what the street had modeled for. So why are shares down then, you say? And the answer is 2014 guidance. Again, the top line was strong with 20 to 21 billion, which is pretty much in line with expectations, maybe a little above, but earnings per share was more troubling. The range of $2.04 to $2.19 is a far cry from the $2.41 the market was pricing the stock for. That's why we're having such a strong sell-off today. Now, I do still like Catamaran quite a bit, especially the company's use of analytics. I think it provides Catamaran with a nice selling point as it has successfully driven down readmission rates through IT and predictive tools. Now, as the Affordable Care Act shifts the healthcare industry from a fee-for-service to a quality of care payment structure, this will become a competitive advantage for Catamaran. It operates in an oligopoly setup with just a few competitors, and I think it has really a nice market position where it can grow, and it is a stock that investors should be watching and not get too bogged down with today's sell-off. All right, let's move on to our headline segment, and our big headline is really another big pharma blow-up maybe in the works. Now, we've seen a number of pharmas aggressively reshape themselves to deal with the threat of the patent cliff. Humira's patent expiration hung over Abbott Labs so strongly that it spun out its whole pharma division into AbbVie. Pfizer sold off its nutrition business and spun out its animal health business to reorganize after losing patent protection on the world's best-selling drug Lipitor. Johnson & Johnson looks to be ditching its low-margin diagnostics business. So we have seen some reorganizations from some of these big stalwart companies. Now, Merck, which I've scolded on the show before for just standing pat, is rumored to be making moves, and the move is going to be potentially a really big one. Its consumer unit is apparently up for grabs, and unsurprisingly, the maker of Dr. Scholl's, Claritin, and Coppertone sunscreen is generating major interest. Potential bidders could include other big pharmas like Novartis and consumer giants like Procter & Gamble. Now, the deal is expected to raise roughly $11 billion for Merck. It appears that this highest bidder auction is the result of a failed swap with Novartis, where Merck would have received some of its units, including potentially its vaccine business, possibly its animal health business. There have been no official comments, and there likely won't be until this deal is consummated, if it is in fact finished. But this is a must watch for investors in the pharma space. An extra 11 or so billion will go a long way for Merck, helping either to restock the pipeline through development deals, or if they don't see anything they like, at a price that meets their requirements, a buyback of shares would also go a long way for investors. Now, Merck has an underrated immuno-oncology asset, 3475. Its competitor, which is Bristol Myers Squibb's nivolumab, has really received a lot of the hype and sent Bristol stock to the moon, but Bristol is now moving more slowly than some expected. This has left an opening for an aggressive Merck, and when you add that to an underrated pipeline, it includes potential blockbuster candidates for osteoporosis in odinecatab, in cardiovascular thanks to anicetrobib, and a BACE inhibitor for Alzheimer's. It means Merck has a chance to really make some waves in the short term. All right, moving on to our game segment. Intermune is down about 3% today, and that follows yesterday's sell-off of about 10%, but this stock is no loser. It was up 170% in a single day earlier this week. 170%! And this is really what we're seeing now is just some natural profit taking after that huge pop. It has a first-in-class IPF drug, which has solid market potential, possibly $500 million or more in annual sales. And after acing a phase 3 trial, I think this drug has a lot of momentum behind it. And since this is Intermune's only drug, I agree with analysts saying that this is a potential takeover target. So let's play a game, which is who should buy Intermune. Now, I'm going to take the three companies named by a Robert Baird analyst, which was Novartis, GlaxoSmithKline, and Gilead Sciences, were rumored to be among the potential interested suitors. Now, let's see where Intermune fits with each of them. Intermune's CEO has already actually sold a company in his history to Gilead, and Gilead certainly isn't afraid to make a big purchase. It spent about $11 billion on Pharmasset, which got it sofosbuvir, which is a drug that's probably going to net it about $6 to $7 billion in annual sales, and it's considered a revolutionary hepatitis C treatment. That said, Gilead did make this purchase in the not-too-distant past, and it hasn't started really making that much money yet from sofosbuvir. So its balance sheet is a little light. Now, it could do potentially a stock transaction. If you look at Gilead's pipeline, though, they have some respiratory drugs, two in fact. Both are in phase 2, but one is for IPF. So unless Gilead thinks it can combo its IPF drugs up like it does with HIV and hepatitis C, or it doesn't like the results it's seeing out of its IPF drug, I don't think Gilead is going to jump at buying Intermune. Now, GlaxoSmithKline does seem like a bit of a natural fit. They have some prominent lung related drugs with Advair and Anoro, but the CEO has come out and said it's not looking for multi-billion-dollar deals. It doesn't want one of these big transformative transactions. It's looking for something more bolt-on. Now, you could actually argue Intermune, since it really is only this one drug, is a bolt-on transaction, but if the price is too rich for Glaxo, then they're not going to be in the bidding, which leaves Sanofi, and I think that's the most intriguing. It does have a biotech division in Genzyme, so it is familiar with the biotech culture. It is increasingly focusing on the rare disease space as well, and I think it could be a natural fit for Sanofi. So that of the three would be the one I would probably be looking at. But again, buyout speculation isn't alone a reason to invest in a stock, and there could be competition for Intermune from Boehringer Ingelheim. But I think this is a stock investors need to watch closely, especially as it goes through the FDA approval process. Remember, this drug was rejected once, but it was for mixed efficacy data, and this more recent trial has cleared that up. We'll see if the FDA agrees, but Intermune is absolutely an interesting stock going forward to watch. And while we're talking about things to watch, let's move on to our watch list segment, because what I'm really focused on is more, and you could say this is more of the same, but the ongoing controversy around Questcor Pharmaceuticals. Now, Questcor shares were down about 5% earlier this week after reporting earnings, and despite a fairly impressive quarter, shipments of its flagship product Acthar jumped 28% to 8,100 vials, causing a 51% surge in sales to $243 million. The company repurchased nearly $1 million in shares and $1 million shares and got a pair of analyst upgrades as well. Now, the market may have been expecting more, especially given its run. It's up 42% this year. Still, if investors aren't concerned about some of the dark clouds on the horizon, the sell-off from earlier this week might have made a nice entry point. However, those dark clouds need to be addressed, and this is really what I'm going to be watching. This is a battleground stock. There are people who take a look at it and say, you know, on one hand, you have a financially strong company with growing sales, and on the other hand, you have a lot of allegations of questionable business practices, including how Questcor markets Acthar. And today, shares are down another 5% after a noted short-selling blog, Citron Research, published a potentially explosive report claiming that after testing 2 different vials of Acthar from different batches, virtually no active ingredient was detected. Now, if true, the implications for Questcor could be incredibly significant. If the FDA investigates, it could cause a freeze in Acthar sales, or potentially worse. If it's not true, this would be a huge blow to Citron, which has earned a strong reputation for uncovering corporate misdeeds. This is why I continue to insist investors watch Questcor from afar. Yes, the stock looks cheap, but there are just too many unknowns here for me to feel comfortable investing, and there are plenty of other great stocks without dark clouds hanging over them. Thanks for watching. Stay tuned to Fool.com for all your healthcare news, and Fool on.